This is Chris Latham, Deputy Managing Editor at Wealth Solutions Report. With me today is David DeVoe, founder and CEO of the M&A consultancy DeVoe and Company. David, it's great to have you here with us.
Hey, Chris, it's a pleasure for me. Thanks for having me.
David, what has been the overall trend in M&A activity for the RIA space so far in 2023 in terms of deal volume and deal valuations?
Yeah. So, it's interesting. 2022 was the ninth successive record year of M&A activity. So, it almost got boring where reporters would call and say, okay, I'm guessing M&A is up yet again. And I'd say, yeah, it is. But things changed. Things changed in Q4 of last year. And we saw a compression, pretty significant compression, about a 20% decline. January and February didn't snap out of it. We're still down. As a matter of fact, it looks like, Q1, we're a couple weeks away from the end of the quarter at this point, but Q1 is likely to be soft, maybe in that 5 to 10% range. So yeah, it's interesting to be living through a bit of a slowdown right now.
How has Federal Reserve interest rate hikes and stock market performance impacted these trends? And are any other major factors at play?
Well, you've touched on the two biggest trends that really have been affecting things, and by the way, there's more beyond that. There's the U.S. economy, there's the global economy. There's inflation, there's this human capital challenge that is very acute for advisors, and gee, we even have wars going on in parts of the globe. So, but those two that you touched on are pretty important in today's environment. I've been doing this for coming up on 20 years now, and the volatility, either continued period of volatility or significant declines in the stock market ends up impacting REA M&A activity. It was almost surprising that for the bulk of 2022, we didn't see much of a slowdown. Even with interest rates going up, we didn't see a slowdown until, it all sort of came together in Q4. So, we have an interesting environment. Um, Interest rates are up, and that's a real cost, right, to buyers. So it not only makes M&A more expensive or an acquisition more expensive, the cash flow of these firms are down to a degree as well. So it's an interesting dynamic where most buyers have not blinked and compressed the multiples they're paying for RIAs, which, by the way, it has been at a record high for about 3 years straight now. But the cash flow of the firms are down because of exactly what you talked about. The stock market's down, revenues are down, and consequently, that compresses the EBITDA and valuations being down a bit. So, um, long story short, today's buyers are sophisticated management teams, and they're backed by smart private equity, and they're being smart about how they do valuations and deal structure to really try to incent an optimal transaction coming together in today's environment.